Good morning, everybody. We are here. It is just Adam again. Jason may be in and out. He's, for somebody who during the pandemic said, "Oh, it's so great not to travel. It's so great to be doing everything from home." Travel opens up and he's all over the place. He's at a conference, I believe, today, probably doing some speaking. Who knows? But he's not here, but I am. So he might be popping in and joining us if he can get out and into a quiet conference room and be with us then. But until then, we're going to talk today about something that a lot of our investors and a lot of real estate investors around the world are questioning. And that is, why would I buy property now with these incredibly low rent to value ratios and the incredibly low cash on cash that we're getting compared to what we were getting a year ago, 2 years ago, 3 years ago? And that is a valid question. It is something that you have to consider whenever you're, looking at properties. And it is true that current run-ups and the lack of rent catching up has made some properties not make sense anymore. Fortunately, we're still sourcing properties that do make sense. So, there's that. But some of the properties that, we might have brought you 2 years ago, we can't bring you now because they don't make sense the day you buy them. So let's look at kind of why the properties that look not as enticing today may be a better deal than we think. And, if it is true. So we're going to talk about modifying the rent to value and determining your true cash on cash. So again, welcome. If you have any questions, comments, or need assistance in any way, reach out to us at jasonhartman.com. Or if you're in the United States, feel free to call 1-800-HARTMAN. You'll find us there. We're here for you no matter what. You can call us. We're free of charge. Happy to help you look over anything, sort out your financing, property management, finding a property, anything you want. We will help you to the best of our ability. So feel free to reach out to us anytime. So we're going to start before the whole rent to value and cash on cash. We've talked a whole lot about the cost of lumber driving up prices of homes. That is, I would say at this point, it's well established. Nobody's going to deny that that's the case. If you listen to the Creating Wealth podcast on Monday, number 1681, I believe it was, Jason talked not just about lumber, but everything. How everything is in short supply, how everything is being driven up price-wise. And that is very, very, very true in ways that I didn't even realize were true until I read some articles recently. If you have any questions, comments that you want to do right now, feel free to leave them in the chat. I will do my best to get to them if we have time. So in this, one of the things that didn't come to mind before that a recent fire in a factory in Louisiana created is when the pandemic started, a whole lot of people started to get pools, which wasn't that surprising. So they started getting pools and checking them out. And we are joined. I'll bring the man himself on. We are joined this morning by Jason. Jason, hey.
Hey, Adam. How are you?
Doing great. We're just getting started. Happy to. I told everybody, I said, travel. He said he loved being at home. And then as soon as travel opened and conferences started, there he is back on the speaking gambit.
Here I am. That's for sure. Hey, I was surprised that you were able to get in and start everything. So
what can I say? Everybody. StreamYard and Google loves me.
Okay, I guess they do. What are you talking about today?
So I was just getting into, remember on Monday's podcast, you talked about how lumber's driving things up, but everything's in short supply?
Yes, absolutely. We are in maybe the everything bubble or the everything shortage. I'm not
sure. The everything shortage. Well, I found a new one and I posted about it in our content creation group. And that's everybody wanted a pool in 2019. And some installers saw a 200% bump in sales. The Better Business Bureau of Western Pennsylvania reported a 25% increase in pool searches. But now there's a major chlorine shortage. Wow. It's going to spoil summertime fun in the swimming pool.
It's just unbelievable. I mean, in meeting with builders the last several days, there is an aluminum shortage. There is a shortage of the handles, the cabinets, obviously the lumber, copper, is doing its thing. It is just a crazy time we're in. And many attribute this to COVID, but they see this lasting for 2 years. That's what many of the builders and the consultants are talking about, that these shortages aren't going away anytime soon.
Yeah, so if you bought a pool in the last year, just know, I mean, this is one quote here, is we're looking for anything that we can get that we don't have here in North Texas. We've been to about 6 states and 15 cities for supplies. Another one called it, Rudy Stankiewicz from Aquatic Facility Training and Consultant CEO said, I call it Pool-mageddon. It's a chlorine crisis. I've lived through Snowmageddon in Texas, but now I guess we're going to have to be living through Pool-mageddon. And one thing here, and it's not just the powder, like the tablets. This owner of the Ask the Pool guy said, I expect pool owners will have to go from tablets to powdered chlorine, from powdered chlorine to liquid chlorine, from liquid to non-chlorinated shocks. And I do believe that all of those are going to literally run out. So it's everything. And then I was like, oh, well, you can just go to a saltwater pool. But even that, the timeline for that at this point is so much that it's not going to happen this year. So the shortage of everything is just it's almost unbelievable at this point in time.
You are absolutely right. It really is unbelievable. And by the way, Adam, I don't know how bad my background noise is here, so
you're good.
I'm just muting. But yeah, and I think it will continue. You know, I did a presentation yesterday talking about the compared to what index and the price of housing compared to virtually everything. We've talked about that a bit on the podcast and the YouTube channel before, but it is truly amazing. The more things we compare housing prices to, the more we have evidence that we're just not in a bubble yet. And yet is the operative word. We'll probably get there, but I see wind at our back in terms of housing price appreciation and significant rent increases, significant rent growth for a couple of years. You know, sadly, the housing affordability crisis is not going to get better anytime soon. You know, the folks in Washington are working on the wrong end of the equation. They keep trying to increase demand. Demand is not the problem. You know, with these tax incentives and so forth, the problem is supply. They need to work on ways to increase supply, incentivize developers to build more homes, loosen building restrictions, loosen building requirements so more shelter can be built for people.
Yeah, I mean, it's just something that, like you said, that nobody in Washington is choosing to look at the main problem. Good morning, Martin C. Housing to the moon. Yeah, I think we may see it getting close to the moon. And I believe what you were saying about the bubble that we've talked about before is so important, in that prices going up doesn't equal a bubble. Prices going up is just price escalation. The bubble comes, and it will come at the tail end. And that is when the whole reason this started ends, and yet prices continue to go up. But we are not at the end. We are nowhere near the end at this point in time. And so right now, it's just a run-up. I mean, that's all it is. It's the fundamentals are there, and it's causing a run-up. And eventually, someday, everything will level out. You know, if the prices of commodities today leveled out and nothing changed, and the price of homes went up for another 3 years, then I would safely say, you know, I feel like I could safely suggest that we are towards the top and probably in a bubble. But the fact is, there's still supply shortages. There's still prices increasing. You know, everything is still increasing, and nothing is being brought into the market to you know, level out the problem. And so, yeah, the idea of us being in a bubble is scary, but I don't think it's actually happening at this point in time. So let's get to what homes actually. Oh, so I was going to say, so prices in 2021, what goes up, we used to say what goes up must come down, but prices in 2021, what goes up keeps going up. So this is the world we live in right now, folks. So it's kind of one of those things, you either, adapt or die? Are those the two choices you have? And right now it's either adapt or get left behind, because with everything going up, you have to protect yourself some way, and real estate is one of the best ways we've found to protect
Hey,
yourself.
Adam, just a quick interruption. I want to show people something that shows you just how crazy the world is that we live in nowadays. This, at my conference, is a sterilization machine that you walk through like a time portal. Watch, I'll walk through it now. It's not smoking right now, but usually there's this mist coming out of it, and it de-germs you here at the hotel at this conference. So it's pretty funny stuff. I don't know how to turn it on, but yeah, here, let's turn it on. I think it'll go on now, and people can see firsthand. I just had to share this with you because I never look at here. Here we are going through the what is that movie about the portal? You know what I'm talking about, right? You know this movie. See, there you go. I'm really sanitized now. Just had to share that with people. Nothing.
Nice. Yeah, that's like Star Trek type stuff you're looking at there. It's welcome to 2021.
Stargate. That's what I was trying to figure out. Stargate. That's the movie.
There you go.
Or the show. Yeah.
Yeah. Oh, Michael. Yeah, Michael called out Stargate. So what goes up in 2021 continues to go up. So let's look at this is a property here that was posted to jasonhartman.com/properties back in January of 2020. And it was actually posted officially on January 23rd. It's a new construction in Ocala that was at the time was $159,900. Was going to rent for $1,325 for monthly rent per square foot of just under $1. Now, this was obviously available then. It was not built at the time. This was pre-construction, as you can see on the screen. So it was probably finished third or fourth quarter of 2020. So then if you look at what was available just now in Ocala, it's not the exact same model because they've shifted what they're building, but this was the closest I could find size-wise in Ocala. $199,000 price point, 1,239 square feet, rents for $1.13 per square foot. So if you look at what happened in just that time, the rent change from 2020 to 2021, in just a little bit over a year, we saw a 15.3% increase in rent for that property. Now, granted, I will admit the price per square foot went up a whole lot more. The price per square foot went up 36%. But if we just look at right now with the calculating our cash on cash and our rent to value and our rent to purchase price, our rents went up 15% in a year, which is incredible in this day and age. I mean, rents you hope in normal times to get 3 or 4% a year. So the idea of getting, 10, 15% is very, very appealing. So I wanted to go a little bit into the math to see kind of what would happen in the potential scenario. So originally, rental property number one that was posted in January 2020, you had an expected cash flow of $200. You had a cash on cash return of 5%, a total return on investment looking at 29, maybe 30. Jason, I wanted to let you know, Ivana said she's glad to see that conferences are coming back. She's looking forward to seeing you in Miami at the George Gammon Live Conference.
Hey, I look forward to it. That's going to be a great event, and I'm going to see George tomorrow. I'm headed down to Cape Coral after this, and can you see my dog on the bed? I think you can.
Yeah, there's Coco
on the messy bed. It's amazing how all these hotels have used COVID as an excuse to provide less service. There used to be housekeeping service every day. And now, unless you ask for it and you schedule it, you don't get housekeeping service. But
wow.
But yes, the George's event is going to be really good, and I think we're even going to have a live event this year, folks. But probably another virtual one first. So that's coming.
Yeah. Oh, we just got a quick question here from Invest in Your Future. It said, would you invest in warehouses to hedge that bet of the upcoming hyperinflation?
Warehouses for what? You mean just like industrial property, or do you mean self-storage? What do they mean by warehouses?
I would assume based on warehousing, they're talking industrial storage.
Yeah.
I don't know anything about that market. I haven't.
I'm not sure. I mean, self-storage has been great. I have many friends that do self-storage investing, and we recently, Adam, I don't know, did you publish that one on the
Yep.
commercial investing
Yep.
podcast yet?
Yeah, go check out the commercial investing podcast that Jason has. There's several interviews there about self-storage, about mobile home parks. We just published one, I believe, last week or so, talking about the current situation in those and kind of the places you can, the opportunities that are available for investors to really maximize their returns in those environments. So yeah, definitely go check that out. The name of it is Commercial Investing Center with Jason Hartman, I believe. You can find it. Go to hartmanmedia.com. You'll find the podcast there.
Yeah, or just the Commercial Investing Show. I think you can just look that up on Apple or iTunes, whatever, any podcast platform. Okay, so what is this one? Oh, Adam, the one thing I wanted to say about your last comment is everybody has to realize that rents always, always, always significantly lag price appreciation, and these rents will catch up.
Right.
Just remember that as a renter, and as a landlord, of course, there's typically a 1-year lease, right? And the rents can only bump every year. But typically, the landlords will have this sometimes bad philosophy of wanting to keep the tenant. And so they will only increase the rent a small amount. But in a market where rental prices are appreciating quickly, it may be hidden because the landlord is only slowly increasing that rent. And sometimes it's better just to re-tenant the property where that tenant can move, and then you can see a significant rent increase where it might be instead of $25, $50, $75, it might be $150, $200, $250 with a brand new tenant. So just understand that kind of dynamic is going on in the market, and that's why these numbers get out of sync in a fast appreciating market. And it discourages investors because they think, well, years ago, as I look in the rearview mirror, even 2 years ago, for example, not that long ago, I could do much better on the numbers. And it's hidden by this slow lag of rental prices. And that just always happens. I've seen it happen many, many cycles over the years. And so people just have to understand that these rents will be catching up to the prices, and the prices, we predict that they still have quite a ways to go.
Yeah, and it's also one of the things I think that keeps landlords wanting to keep tenants in place is so many of them use property managers. And property managers, whenever you have a turnover, they sometimes push you towards doing turnovers that are more expensive because they can make money on the maintenance side of it. And so they're, you might think of it and think, oh man, is upping the rent another $25 and potentially losing this tenant worth, the $2,000 turnover bill that I'm going to get from my property manager? And if you think about maybe doing self-management, maybe there's some things that, don't really need to be fixed or can wait a year or two, and it's not that big of a deal. And, then you might be more likely to be willing to re-tenant the property. So that's just an idea. I recently started self-managing my 2 properties in Jackson, Mississippi. I haven't done a turnover yet, but I did tell my tenant there, we had to get them right at the beginning of COVID. So we had to drop the rent to get him in at the time. And he's massively under rent. And I told him, we're going to have to go up at least $100 or he needs to get out. He owes me his decision in the next 10 days.
Right.
So
and what landlords a lot of times don't realize is sometimes the best thing that can happen is the tenant can move. Yeah. Okay. It's kind of like if you liken this to personal relationships, we've all had various loves of our life, hopefully, right? And sometimes we don't want to give up that relationship. We kind of want to keep it going, but we know it's really not going anywhere. But sometimes the best you can do for both parties is to just move on and find another relationship. Ask Bill and Melinda Gates.
Oh. Now, I will say I'm an example of the bad landlord, though, because what I told him and what I know in my heart is true is if he leaves, I can probably raise the rent $150 or $200.
But if he doesn't leave, what is the rent increase you asked for?
100.
100. Okay.
So
And
I'm
that's a
leaving money
pretty
on the table.
big increase for, and by the way, what is the rent now?
The rent right now is $750.
Okay, so for a low price property, only $750. That is really inexpensive.
Yeah.
You want to make it $850, but if that tenant leaves, you'll probably get $1,000 or
Yeah, I'm gonna ask $950 or $1,000 probably for it whenever if they do leave. So
and the likelihood is you will get it. What is that property worth right now? Have you checked lately?
Last I checked, I think it was worth about 85 or so. We bought it for 80, or we bought it for 75, and it's up to somewhere in the 80 to 85 range, I believe.
And by the way, just even having this discussion, I almost feel like we just made a huge mistake because it is very hard to duplicate these really inexpensive properties anymore. We used to have lots of them, but now most of our investors are buying properties that are $250,000. New construction, $300,000. I mean, the market has just dramatically changed. Adam, do you want to speak to that?
Yeah. So I was actually going to dive into a little bit about the numbers here that make it look a little better. But yeah, I'm buying properties that come available on the network rarely now because these were purchased multiple years ago. Whenever, like Jason was saying, our inventory was just flooded with $100,000 and less homes. And if you wanted to buy a property under 150, it was take your pick. Now it's if you want to get a property under 150,000, it's wait and see what comes available. You have to be we've talked about being market agnostic. If you are looking for a property that is under 150,000 in today's marketplace, you better have zero attachment to geography and be ready to just say, give me that house. That's the mindset you have to have in today's environment. Now, that is not saying once you get the contract and see the property, you shouldn't do due diligence. But if you want the opportunity to purchase the house, you have to just say, if I'm your investment counselor, I'll just use myself as an example. Say, Adam, the next house that you see that's under 150, send it to me and I'll tell you if I want it. It's not, if you tell me the next one in Memphis that's 150,000 or less, you'll be waiting months. If you tell me the next one in the market that's under 150,000, you might only be waiting 2 weeks, 3 weeks. I don't know. I can't guarantee anything. But if you make it market specific, it's going to increase your timeline significantly because these properties just aren't available. So, but if we want to go into kind of what Jason was talking about in terms of rent increases, I want to look. This was the original pro forma for the Ocala house. This is the 1,300 square foot one. It was expected to cash flow $200, 5% cash on cash, 29 or 30% total return on investment. Now, this is also, keep in mind, 6% appreciation numbers. I didn't run the numbers with 36% appreciation because those numbers would have been completely unbelievable. This is number 2. This is the one that was posted on March 30th. And this cash flow is $161 with a 3% cash on cash return and a 28 or 29% total return on investment. So the question is it a good deal, or should you bother with it? But now I'm going to look at, if we look at the rent increase that happened from 2020 to 2021, we said it was 15%. Well, let's just say, for the sake of argument, from now until this property is completed, which is probably going to be early 2021, that there's a 10% increase. We're going to assume there's a 10% increase, and we're going to do it on price per square foot instead of price, total rent, because we never know exactly how big the house is going to be. So if we have $1.13 now, which is what the last Ocala was getting, a 10% increase would take us up to about $1.24 per square foot. Now, this $199,900 property would rent not for the, I believe, what did they originally have? Originally, they expected it to rent for, didn't put it down, but I think it was like $1,400. Now you're looking at a $1,525 rent for the property, which puts your rent to value more in line with the 0.7, 0.8 that we've seen on new construction in the past. What does that do for your return? Well, now suddenly you're looking at a $312 cash flow. You're looking at a 6% cash on cash return. You're looking at a 31% total return on investment. This is one of the things that we've talked about. It's the don't wait to buy real estate, buy real estate and wait. Right now, you are literally buying the real estate and waiting because they are building the property that you're buying. And when you wait for that turn, you're not putting your money to work yet. You are setting it aside to be used later, but you are seeing your return increase as they're building it because the time is on your side. The time and conditions are lining you up for when this investment actually kicks in and takes place. You're going to see returns better than you were expecting on paper. I'm going to go into it next time we do a live stream. I'm going to crunch the numbers of the property we just closed on in Atlanta. And the numbers that I ended up getting, they weren't quite as portfolio changing as I was hoping because interest rates jumped up while we were doing it, although we still got a great interest rate. But the returns I got cash flow wise were better at 20% down than they were expected to be with 25% down because of the time allowing rent increases. So this is just an example of what can happen when you allow that time to take place and to help your investment. Jason, any thoughts?
What's that, Adam?
Any thoughts?
Well, a lot of them. First of all, you're absolutely right. Don't wait to buy real estate, and then wait. It is still overall cheap now, believe it or not. When you look at it compared to all of these other assets out there, when you compare the price of real estate, the median price home, to the price of oil, it's a little bit cheaper than it was, get this, 21 years ago. When you compare it to the price of many, many things, rice, orange juice, just a whole host of commodities in the world, it's just not that expensive. And it gets even better when you compare it, when you compare the median mortgage payment to the price of all these other commodities. It's really cheap because you've adjusted for interest rates. And then when you adjust for inflation, the price of housing now is actually cheap. So it's amazing. And I know that people are thinking that the numbers aren't as good as they used to be. Well, they're not as good as they used to be a year or two ago, sure. But overall, when compared to all these other commodities, when you don't just compare only to dollars, it's pretty darn amazing. And we can kind of see that with the questions and the comments people are making here. Again, this ultimately could turn into a bubble. I couldn't agree more, but overall, it's looking very good.
Yeah, and I think this almost needs to become another part of your due diligence, and that is looking at not just the rent on the pro forma, especially, if you're buying an existing house that's going to close, in 30, 60 days, then the numbers on the pro forma are going to be the numbers that you're working with. But if you're buying one of these properties that is going to be ready 6, 7, 9 months in the future, part of your due diligence needs to be reconfiguring the pro forma to what you can expect rents to be at the time of close, and really adjusting and looking at what your cash flow is going to be then. What's your return going to be then? It's because the numbers that you're looking at are the numbers now, today, but you're not closing today. You're not closing tomorrow. You're closing at, in the future. So what is it realistically going to be at that point? And that will change all the numbers. I mean, be conservative when you do it. I'm not saying go out there and say, well, Jason and Adam said it's going to catch up, so we've got my rents are going to go up 20% in the next year. I wouldn't go that far. Be conservative. We like people to be more conservative and, a little less risk averse whenever you're doing the numbers, so you can be happy about the deal at the end, not disappointed, but really look and see, how the rents have been trending in the market and what could potentially happen between now and then. I think that will make everybody see that the returns look meager, but they're not as meager as they look.
Yeah, I agree. Folks, it's really quite a bit better than it looks. And if you look at what builders are building, they are just not building economical houses at all. There is just nothing in the market that is on the lower end of the spectrum. You see articles, Adam, and you've seen them. We've talked about them a bit, of how there is some relief coming because there are more homes being built in the pipeline. Developers are getting a little more active. Well, if they can get the materials, if they can get the construction materials, that's the first challenge. But even when they do, the homes they're building are $600,000, $700,000, $800,000. These are not rental properties. They're just not building anything to speak of. Now, when I say that, of course, it's a figure of speech. Of course, there are lower end builders. There's, D.R. Horton. There's KB Homes. They're building at the lower end of the spectrum. But the definition of lower end has changed dramatically. I mean, when I got into this business of helping investors buy properties and build nationwide portfolios, and I started investing nationwide back in 2004, you could buy a brand new home from a D.R. Horton for $150,000. But you can't even touch that anymore. I mean, and that was in your town in Austin, Texas. Not even close. That same house today is well over $300,000, and the stuff being built isn't anywhere near that price range for new product.
Yeah, that's that's pretty incredible. I will say, I'm trying to pull up. Here we go. You were talking about the homes, and let me share this with people.
Are you sharing questions? Because I logged in so I could do it too. And this one.
No, this is going to be. I'm going to share a screen. Jason was talking about how they're not building homes like they did, and when they do, they're they're changing things. So I'm going to change this, and I'm going to share a different screen. This was a home that I used to personally in Houston. You're talking about how builders are changing things, and now it's not. There we go. This was the home that Erin and I, my wife, moved into whenever we got married, and it didn't have this horrific paint job, and this little wall didn't exist. But you can see it's a little bungalow house, 1,200 square feet or so. Two bedroom, 2 bath. Well, this home, it was sold for $300,000 2 years ago. You want to know what it looks like now?
Hey, sure.
Now,
I have a feeling I know already, but
now it looks like this. Where'd it go? There.
Little technology issues here, folks.
Yeah. This is it now.
Wow. So they've added on. They've done.
Yeah. Oh no, they tore it down.
Oh, they
bought it for $300,000, tore it down, and built it, and it's now for sale for $1 million. Or it's not for sale, but it sold for $970,000 or something like that.
Wow. So you can just see that the incentive is to maximize the land value. This is the principle in real estate and in the appraisal world of highest and best use. So they're just wanting to improve that property to its maximum highest and best use. And by the way, this is the comment I wanted to bring up on the screen. The shortages are real. This is one of our viewers. I know construction workers are not working because they don't have supplies. Well, true, that's not the only reason they're not working. Number one, the government is incentivizing people to stay home. Companies, especially restaurants, are struggling to get workers to come to work. They're hiring, they're trying to hire. When I was walking around, I'm in Sarasota, Florida now. When I was walking around last night, and there are all these great little cafes here. It's just a charming city. There were signs, those A-frame signs that sit on the ground where they usually write in chalk. They write the menu or today's special or whatever it is, right? Instead, those signs said all positions open, hiring. And the restaurants can't get people to come to work. And with the builders, the construction, they're having similar problems there because it is so profitable to stay home since the government is overpaying people not to work. So that's another problem. Big labor shortages. Absolutely.
Yeah, and it doesn't help that after 2000, after the Great Recession, they didn't go back. They, left and found new jobs and didn't want to come back and risk the chance that the housing market would crash again and they'd be out of a job again. And, at some point, we're not incentivizing people at a younger age to go into the trade. And then you have the older people. I mean, if you're 50, 60 years old and you were working or, were in housing and then the Great Recession hit, you're not going to chance going back and, leaving your family in that kind of situation if it happens again. I mean, it's, you're not going to think, oh, in 15 years, I'll learn new skills to make a living if things go bad. So, I mean, we're not in a situation that's conducive to continued, I guess Coco's done with the bed. Continued.
I decided I should make the bed considering I have company. I'll make the bed in my hotel room because there's no staff to make the bed for me.
So let's see. Let's see. We have one here. RHB 30,001 says, "Why should I buy now at high rates?" RHB, I would like to posit to you that at 20% down, you can get an interest rate of, like, at the high end, 4.375. That to me it's higher than it was 2 months ago, higher than it was 3 months ago, but it's not high.
It's historically incredibly cheap. And if you look at all of the data on inflation right now, and you see what's happening with commodities prices and what's called the PPI, the Producer Price Index, which is what companies are having to pay for the materials to build their widgets. I'm not just talking about houses, right? There is so much inflationary pressure. In fact, Peter Schiff said just last week, he said that real inflation right now is between 10 and 12%. So if you're borrowing at any rate lower than that, or any rate lower than whatever you believe is real inflation, everybody, of course, has their own personal inflation rate, you're getting paid to borrow the money. Okay, you're getting paid to borrow the money. And with income property, it's one step better than that, and it's a huge step better. And that is that you're not paying the mortgage. Your tenants are paying the mortgage. So you don't even pay your own debts. You don't even pay your own mortgage. You outsource the debt obligation to the tenants. It's an absolutely incredible asset class.
Yeah. Plus, you're almost going into it like a foreign exchange account where you can leverage yourself 5 times to get with the loan. So if you're talking about rates, interest rate wise, they're higher than they were, but they're still low. If you're talking about rates of property prices, well, they are higher than they were, but they're, like we've been talking about, they're not getting any cheaper in the near future.
That's for sure.
And even by the time, let's say the 2-year time frame is right. I think it could go potentially longer, but let's just say 2 years is right. And you're seeing, 15, 20% appreciation over those 2 years. Well, you look at it, if it's 100 now, it'll be 120 in a year, and it'll be 144 a year from that. Well, unless we're going to see at that point a 35 or 40% drop in housing, which I don't foresee that happening, then you're, even at a 35% drop, I think you're back to square one. So that'd be a monstrous drop, and there'd be so much wrong in the economy. If your money was in the stock market, you can kiss it goodbye. If there's a 35% housing drop, there's no safe place to be if housing drops down to the levels it is now in 2 years. I don't think.
Yep, we'll see. I love this comment, and I love the screen name, the Moody Millennial. I just love that. That's great. Go into any retail store. You can't get help from any employees because there aren't enough. Couldn't agree more. Same with the restaurants. I think we're all coming to expect a new level of service, which is crappy service. They're just understaffed. It's not even the employee's fault necessarily. Sometimes it is. Sometimes they're just bad, but they're just understaffed. They're overworked.
Or as Jason calls it, the hidden inflation.
Yeah, absolutely. It's the hidden inflation where we're just getting less but paying more. I'm at a nice hotel here in Sarasota with a gorgeous view of the water and so forth, and it's just understaffed. There's just not enough people working at these places. They're trying to automate everything, and it's just totally understaffed everywhere you go nowadays. And high rates. We didn't know if that meant high rates or prices. Yeah. Okay.
So RHB, you say, why buy now though? And that's kind of what we've been talking about. Is you have to look not just at this exact moment in time, but in the future. And when you look out at the future and you see what your returns are likely to be and what you can expect them to be, you will find yourself much, much happier. And it's very possible in 3-4 years you could refinance, you could do a refi on this new construction property that was $200,000 and get pull more than your down payment out, and basically be at that point your infinite returns.
That's the refi till you die strategy. Go on the YouTube channel, go on the Creating Wealth podcast, and look for more on the refi till you die strategy and the inflation-induced debt destruction strategy. Because what Adam is mentioning there are very powerful tools for your portfolio. Good stuff.
Yeah. So Moody Millennial said, I do loan closings, and plenty of people who didn't get economically affected by the shutdowns are upgrading their housing. And that is one thing, Jason, you've talked about it before, with all these people not selling their homes, but they're going to, update their homes and do that. That still creates a demand for supplies that the builders have to compete with. It's not necessarily they're competing with another home builder, but they're competing with somebody who wants to add on a building in the back of their house, who wants to add a pool. And now they're, if they're building a home with a pool, they're competing with them for the concrete and the chlorine, like we talked about, and everything else,
and the lumber and the and the steel and the glass and every product and the copper wire. So they are competing for those very scarce building materials.
Yeah. So let's see. We've got robo employees soon. Boston Dynamics are getting close.
Yeah, that's true. The robots are coming, folks. And they're coming, and they're going to affect all sorts of areas of our lives, and just automation in general and AI. We've talked about that extensively on the podcast, and we'll continue to. So, yep, good point.
Yeah. Buy because prices are actually cheap, Bad Instinct says. Based on the investment perspective, the mortgages are essentially negative rates, and a tenant is paying the mortgage. Absolutely. It's
you're absolutely right. I think Bad Instinct has very good instincts, actually.
Fish Fat says, thoughts on the upcoming changes to the 1039E.
What is that?
I do not know what a 1039E is.
I better look that up. I hate to say I do not know what that is.
Jason will have to not Google it.
Yeah. We will have to search that one. Okay.
Here we go. Joseph says, soon Home Depot will need Brinks armored trucks to bring in the valuable lumber.
That's true. And if you in the presentation yesterday that I gave here at this conference, I showed that meme that has been going around a bit of there's a couple and they want to have a romantic dinner. And Adam, you've seen it, of course. It says, "Take me somewhere expensive," and they're having a romantic dinner at the lumber yard. So, yeah.
Hey. Yeah, and then there was the other one that Sarah posted in our Voxer group that I love. That was a car with a piece of wood through the windshield, and it said was going to fix my car, but instead I sold the plywood and bought a new one.
Right. No need to file an insurance claim.
Okay, so it was clarified here. Fishfat said the 1031 exchange.
Oh, 1031 exchange. Yes. We are definitely concerned about that. I'm doing a 1031 exchange myself right now, as I've talked about on the podcast. And, the Biden administration wants to limit that to $500,000 per year in deferral, which is nothing because, most people have as part of their 1031 exchange, there are two components. Not just the issue of the property being purchased at one lower price and sold at a higher price, but also what's called depreciation recapture. And that depreciation recapture can be very significant. So $500,000 in deferral per year is nothing. This is, we predict that this will funnel billions and billions of dollars into smaller pieces of real estate, smaller properties, whereas big institutional investors will be incentivized to get out of large apartment complexes, large office buildings, retail centers, and be incentivized to buy more smaller single-family homes. Because remember, they can have those properties, even if they're a big institutional investor, owned by separate entities, separate LLCs or separate corporations, and they can play a lot of games with that $500,000 maximum deferral amount on 1031 exchanges, and just get around those rules. There's just a lot of creative stuff they can do here. So this could mean bad news for larger commercial properties and really good news for that money moving into the smaller single family home market, which for probably everybody listening, you're a single family home investor or a potential single family home investor. And this could put more and more upward pressure on prices and rents. So really consider that. We don't know if this will happen yet. It's not for sure. But look, the Democrats or I should say the inmates are running the asylum right now. And Adam is happy about it. Look at him smiling.
No, I don't understand the thoughts behind. I don't understand why the 1031 needs to be made out to be a bad guy in this whole process by the politicians. It doesn't make a whole lot of sense. And the whole unintended, I get that what they're talking about, how the 1031 has been more from its original envisionment. Who cares? It's changed. Yes. Is it destroying anything? No. Is it helping the economy? Most likely. It's the unintended consequences that could come out of this. I mean, if you think it's bad now in terms of home prices and buying a low price investment property, just wait until, we've been working with builders and suddenly, 100 properties disappear because some hedge fund wants to buy. Yeah. Just imagine whenever all of the hedge funds decide, we're not going to deal in, these $40 million multifamily office buildings, whatever. Yeah. We're going to go in and we're just going to buy the builder, essentially, like basically say anything you build, we want. If you think it's hard to get a property now, look out.
You'll be competing with more and more institutional investors that are really, really just moving more and more into our game. So it's it's really quite something.
Yeah, one of the things that I'm very curious about is now that more and more institutional money's coming in, is when the next Great Recession happens, when the next housing crisis happens, seeing how they are able to work their way through it with the returns that they are expected to produce. I don't know exactly how that's going to shake out for the single family market, but I know it will be an even bigger issue if the 1031 exchange happens, the changes happen, and they get even more invested into the single family market. I don't know enough about their business model and all of that to make a good guess on
The
that.
point is, though, no question, the motivation will be to go into a lot of smaller price, lower price properties, single family homes, and get out of the big, like you said, Adam, the $40 million apartment complex, the $40 million shopping center, the $40 million office building, right? Because they can work their way around. They have a lot more possibilities and a lot more flexibility with the residential properties. And, I wanted to just grab a couple of these questions, and I know we've got to wrap it up here soon, but
we have one here from Diane Nguyen.
We're both operating the questions now unusually. So let me just grab these two because this is the mood of millennials back. Are you concerned with the American Southwest population growing so much that water supplies for the entire region are dwindling so fast? Yes, that is definitely a concern. But what's interesting is this follow-up comment by Bad Instincts. Doesn't Israel convert salt water into fresh water? No concern. Yes, but that is very expensive. It takes a lot of energy to convert salt water into fresh water, the desalinization. One hope that might make that cheaper is this incredible material that you may have heard of called graphene, which maybe that will make desalinization a lot less expensive. But right now, it's very expensive. It takes a lot of energy to push that water through the filters to take the salt out. So it's a very expensive process. Adam, go ahead.
On the other hand, California hasn't had water in how many decades?
What's that?
California hasn't had water in how many decades now?
Yeah, but there's always been a water crisis in California, it seems. But yeah.
So Thy Van Win says, living in California, I want to buy investment property. What city or states make the best cash flow, please? Well, I will say we had a response here from Bad Instincts that I disagree with. Said Cali doesn't look like a bad place to invest in now, since many people are moving out. You can find good deals. Kind of tackling
those deals are going to get a lot better.
Well, they're going to get a lot better, but then the question becomes: do you want to be an investor in California? I mean, let's pretend that California real estate gets so bad for a little while that the numbers that you can break even maybe on your cash flow, which right now you're nowhere near that. But let's say you can break even. You still have to deal with the fact that you are not in control of your property. Your tenant is essentially in control of your property, because have fun getting rid of them. All the things are lined up in a way that the eviction process takes forever. The tenant can just make small, from what I understand from some things I've heard at Meet the Masters, your tenant may make a small payment and suddenly it resets things. Just California is not landlord friendly. So even if it can break even, the question is, do you want to wrap your money up somewhere that they don't care about you? So when it comes...
Yeah, what Adam's saying is absolutely right. No matter what, no matter how good the deals are, and they're not very good, but California is a tenant-friendly, landlord-unfriendly state. We want to invest in places that are friendly to our cause as landlords. Okay, if you get a bad tenant in California, in Oregon, in New York, in Washington State, well, maybe Washington State's not as bad, but just any of these left-wing jurisdictions, it's hard to get rid of them. It's hard to enforce contracts. And when contracts can't be enforced, society falls apart.
Yeah. So if you're looking for what city or states make the best cash flow, go to jasonhartman.com/properties. But we focus a whole lot right now on the Southeast. We're looking in Florida, we're looking in Alabama, we're looking in Tennessee, we're looking in Georgia. those are, the places where people are moving and are friendly to landlords, and the deal still makes sense. So that's really the action in the U.S. in investing and in terms of being friendly to business is in the Southeast.
Yeah.
So.
Okay. Adam, you want to grab any more questions?
Yep. Jesse Mansfield asks, thoughts on impact when the forbearance and foreclosure moratoriums end?
Great question. We've been talking about that, but not quite enough lately. So I'm really glad you brought that up, Jesse. Just not a significant enough problem in terms of numbers. These numbers, in comparison to the demand and the market shortages, are nil. They're just not that significant. They could cause some more properties to go on the market, but just it's just not very significant. I would love to see some more properties come on the market. I mean, please let these moratoriums end. Let's have some foreclosures cycle through the market, have some price discovery. Sounds good to me. I'm all for it. So just not a concern at this point. Okay?
Yeah, I mean, you really need to remember and take it in the where they are as well. I mean, you're looking at, I believe the last number I saw was something like a couple of million people. It was on the low number, maybe like 2 or 3 million people still in forbearance. And then you have to split that up among the 50 states. And then you have to look at what states are actually places you want to invest in. And then you might talk about some inventory coming up. But right now, whenever you have...
Adam, just one second. There's one more huge thing we've got to mention there. And that is that a lot of these properties will never reach a foreclosure.
Yeah,
I mean,
they'll get worked out.
The vast majority will never see a foreclosure. They'll do workouts. They will sell the property. They will refinance the property. They will, they'll do loan modifications. Just because they're in forbearance doesn't mean they're going to go to foreclosure when forbearance ends. Folks, like a tiny percentage of those will even ever get to foreclosure stage. And if they do, great. Yeah. We could use some more housing inventory. The demand is so much higher than any potential supply here at this point that this is just not a concern at all. Okay.
Yeah, that's where I was headed is, even if it flooded the market, I mean, you look at most places in the US and they have 1, 2, 3 months of supply in the marketplace. So even if you flooded it and dumped 2 months of supply on them in a week, no big deal. I mean, that'll get absorbed in 2 weeks, honestly, 3 weeks. It's not something that is going to impact it that much. It maybe it'll slow it down just a little bit, but then they'll get eaten up and we won't have any inventory again. I mean, we're in such a seller's market and inventory is so low that the amount that we need cannot be satiated by even all of the things in forbearance coming out.
It's just not enough. It's not enough potential supply, and it's not going to happen. Okay, Adam, we got to wrap up here. Yep. So this is an interesting question, and I wish there was a little more detail on it. But by the way, folks, we always forget to ask you, but please click the like button. Okay, please click the like button, and make some more comments, subscribe. Make sure you subscribe to the channel if you're watching on YouTube. If you're on Facebook, just click like, but make sure you go to YouTube and subscribe, and then also subscribe to the Creating Wealth podcast. We always forget to ask, so please do that. Okay, we'd really appreciate it. Turn on notifications so when we do these spontaneous lives, today wasn't one of those, you'll be updated. And but this is a good one for you to reach out to us, this question here, because I don't know that I understand it. Adam, do you?
I do not fully understand this.
It kind of seems like he's saying instead of make it a tenant agreement, make it like a licensing agreement, which is interesting. Here's a little more elaboration, maybe. So I purchased a home. The seller stayed 15 days after closing. It was a rental license and had a provision where I can evict without going to court. Where was that? Or we don't know if you're in a foreign country even. We don't know where you're located. So what jurisdiction is that? I will tell you though, there is a principle in law that is this: if it walks like a duck and talks like a duck, it doesn't matter what you call it; it's still a duck. Okay. So that's one thing. Okay. And he says Sarasota. Well, that's where I am right now, Sarasota, Florida. So I don't know, I just have to know more about it. I understand the concept of holdover, and this was just 1 month ago. Did you kick them out? My bank was okay with it. Oh gosh, I don't know. Call us, let us know more about this, or go to jasonhartman.com/ask. jasonhartman.com/ask, and fill us in like this, or talk to one of our investment counselors. I'd love to kind of hear more about this stuff. Okay. Yep. Adam, shall we wrap it up? I gotta go. I gotta get back to the conference because I don't want to miss lunch. Okay.
Yeah. So head on over to jasonhartman.com. Reach out to us. Like Jason said, if you have any questions, comments, anything, go to jasonhartman.com/ask. We'll try to tackle it in the live stream or on the Creating Wealth podcast. If you're in the US, call us 1-800-HARTMAN. And and go to pandemicinvesting.com to get your free report.
Oh, yeah. We've got a free mini book at pandemicinvesting.com. So make sure you check that out. It's totally free, no strings attached. It's just emailed to you right away. So enjoy that, pandemicinvesting.com. And until next time, everybody, happy investing. We'll be out with a new podcast later this afternoon on the Creating Wealth Show. So be sure to check that out. And Adam, great job always. Let's give Adam a big hand. Thank you, Adam. Appreciate it. And thanks for joining us, everybody. Happy investing.